Hey everyone, on 15th May, Nifty has crossed a significant threshold of 25,000 level, making its first close above this level since 15th October. So after 7 months, Nifty is back to 25,000 level and now just 5% below all-time high. The most interesting part is, just 5 weeks ago, Nifty was at lows of 22,160 on 7th April. What a sharp recovery. As far as mid-cap and small-cap are concerned, they have also witnessed sharp jump with mid-cap index rising 15% from 7th April lows and small-cap index rising 16%. So this rally in last 5 weeks has surprised everyone. I mean, just a month ago, everyone was concerned over Trump tariff, and then we witnessed India-Pakistan conflict. Now suddenly the tide has turned. Those who were talking about Nifty at 21,000 levels are now talking about Nifty at 28,000 and even 30,000 levels. Honestly speaking, this recent rally is precisely the reason why I always say that it's impossible to time the stock market. And if you're a long-term investor, it's very important to remain invested, especially during the difficult phase. Because by the time we realize that all problems are over, market already touches a new high. You never get both good news and good price together. Now in this video, I want to discuss factors that resulted in the sharp rally in Indian stock market in last 4-5 weeks. The big question here is this rally sustainable? What about valuation? I'll share my viewpoint on this. Alright, let's get started. So the first big factor behind the recent rally is optimism on India-US trade deal. If you recall, Trump had put a 26% tariff on India, and right after that, Indian market tanked badly in first week of April. But markets are always forward-looking. In the latest development, it seems like the tariff issue seems to be over. In fact, Trump has recently mentioned that India has offered zero tariff on import of US goods. However, later, India's External Affairs Minister S. Jaishankar has said that nothing is finalized yet. But it looks like the market is optimistic and expecting that both countries will come up with a solution on trade deal. And market is certainly negating the initial 26% tariff on India. But please note that it is an ongoing development. At the moment, sentiments are positive on tariff, but any negative development can quickly turn the sentiments negative. Then second factor is FI inflow into Indian market. After a massive selling by FIs from Indian market, FI seems to be turning positive on India, with March and April turning positive with a small net inflow. But first half of May month has surprisingly witnessed 24,000 crore inflow so far. So earlier, only DIs were the net buyers. But in May month, both FIs and DIs have become net buyers. Then third positive factor is cooling inflation rate in India. In the latest data, inflation rate in India has cooled down to 3.16%, which is the lowest since last 6 years. It basically means RBI can have further rate cuts. And lower rate cut means cheaper borrowing that would boost the consumption demand in the country. Also, when the inflation cools off, the raw material prices and other expenses for corporates reduces. And if the demand remains strong, it means more sale and better profits. On top of this, India's GST collection has hit a record high in April month, and India's manufacturing index, that is PMI index, has also hit a 10-month high level. All these factors have resulted in reinforcing investors' confidence. Technically also, market is looking very strong. Nifty gave its first close above 25,000 since October 24, which is a major psychological and technical resistance. This breakout is bullish. Nifty is trading well above 50 and 200-day moving average, confirming a strong uptrend. So as per technicals, momentum is strong and trend is bullish. Some short-term consolidation or pullback may happen near all-time high, but technically a further rally is possible if global cues remain supportive. So as far as macros like GST collection, PMI index, then inflation, etc. are concerned, it has always been strong for India. I've discussed it multiple times in the past. India's macros are solid. The only concern was higher valuation and temporary slowdown in corporate earning. And of course, the geopolitical uncertainty created a lot of confusion. Now let us try to understand, is this rally really sustainable or not? And what can be the expectation from current levels? As far as sustainability of current rally is concerned, there are a few positive factors that can support this rally. So first factor is of course the FII flow. If FII continue to invest further, Indian market would be able to sustain this rally. DIs would anyway continue to deploy money thanks to the SIP that has consistently crossed the mark of 25,000 crore per month. Second factor that would support the rally is strong macroeconomic factor. be it fall in inflation, reduction in interest rate, record GST collection, strong manufacturing data. If Indian economy continue to remain robust, market should remain in upward trend. And third factor that would support the rally is geopolitical stability. If India-US strike a good trade deal, which is beneficiary for both countries, market would cheer it. Plus, if India-Pakistan issue does not escalate, it would be positive for the market. Having said this, there are a few concerns that can result in pullback in the market. First concern is lofty valuation. Please note that Indian markets are not cheap, unlike the COVID days. For instance, Nifty 50 is trading at a PE of 22-23 level, which is about 10-year median valuation of around 20. Nifty small cap is trading at a PE of 31-32, which is again on the higher side. And majority of growth stocks are trading at more than 50-60 PE multiple. As far as quarterly results are concerned, it's been a mixed set of earnings so far. In Nifty 50, 24 companies have given positive profit growth and 12 companies have given negative earning growth, 2 with neutral profit growth. Total revenue has grown 6.3% year on year and operating profit has grown 8.1%. So it's been an average performance. Nifty Midcap 100 revenue has grown 6.8% and operating profit has grown 17.3%. So Midcap segment has shown better operating growth. And Nifty Small Cap 250 revenue has grown 5.7% and operating profit has grown 12.6%. Overall, 213 companies have given positive profit growth so far and 97 companies have given negative earning growth, 19 with neutral profit growth. Total revenue has grown 5.7% year on year and operating profit has grown 9.8%. If you look at EPS growth in Q4, Nifty 50 EPS is at 1117 as of 16th May. That translates to 1.5% growth since 1st April level. Nifty Next 50 EPS has grown 2.9%. Midcap 150 has done much better at 5.9% EPS growth quarter on quarter, and Small Cap 250 EPS has grown minus 0.12% quarter on quarter. So overall Q4 has been a mixed bag. Average growth in large cap, stronger in mid cap and mixed growth in small cap. Apart from this, the geopolitical challenges are not yet over. Any negative development on India-US trade deal or India-Pakistan tension can create negative sentiment and impact the markets negatively. Overall, the latest rally in Indian stock market has created a positive sentiment among investors. Technically also, market is showing good strength and many people are expecting that the bear market is over. Now, I have said multiple times in the past, we can't time the market. It will always recover much faster than we anticipate. Hence, as a long-term investor, time in market is more important than timing the market. Having said this, the current valuation does not give enough comfort for a one-way rally from current level. But market can remain irrational. And if that happens, market will again become expensive. So the best strategy at this point is not to get too excited. If you are already invested based on your long-term goals, do nothing. Let your compounding work. And if you have surplus cash, don't rush. Use SIP or STP strategy to deploy gradually in quality stocks over a period of time. And avoid jumping into small cap blindly just because they've bounced hard. Valuation in some segments are stressed again. This rally is driven by global tailwind and strong FIS flows, but those flows can reverse quickly. Focus on asset allocation, not short-term momentum. Remember, market highs are not a signal to exit or go all in. They are a reminder to reassess your strategy and stick to your plan. Also, don't let the fear of missing out, that is FOMO, guide your decision. Market will always create opportunity, but wealth is created by those who stay consistent, not those who chase headlines. Thanks for watching this video. If you find it useful, do share it within your circle and let me know if you want me to cover any specific topic. I'll see you next video. Till then, take care.